So welcome everyone. Thank you for joining us for this session titled Internal Controls, Audits, and IRS 990s, what every board member needs to know. We'll do our best to keep it engaging and give you just some, draw from our knowledge, just some background. My name's Nick Hoffman. I'm a CPA. I'm a sole practitioner based in Kennett Square. I focus on individual and business tax. I sit on 2 nonprofit boards. So I've been on boards for probably about 6 years now. So I'm fairly well versed in the tax side of things, the financial side of things. That's how I try to provide value to those boards. And my presenting partner today is Cindy Ray.
Hi, I'm Cindy Ray. I've been in the nonprofit finance world for way longer than I'm probably willing to admit, but I'll say 30 plus years. And I'm also a CPA, although I'm not in public practice anymore. I am the CFO for a nonprofit organization in Philadelphia called Visit Philadelphia. It's a marketing arm trying to bring tourists into the city. What we want to go over today, I was going to say, but let me stop and say, those conversations that you were just having are like the most important ones that happen in a day like today. And so I didn't want to stop it because I thought this is great because you're really getting something that you need and want and connecting with one another. So that's great.
Okay.
So I'm not sure what everybody is hoping to get out of today. Maybe I'm going to try and keep it at, the 30,000 foot level. I'm not going to go into the details of auditing a nonprofit and that sort of thing. But this falls under, when you're looking at board duties, what we're talking about here is under protecting the assets and providing financial oversight for the nonprofits that you serve. If I go through these, through the stuff that's in the handout, it starts with what are internal controls, and if you talk to any finance people, particularly your CFO, or if you have one, or controller, or even your bookkeeper, you're going to hear about internal controls and how important those are, really in any company, but particularly in a nonprofit organization, because there's no ownership. There's no owner to be responsible to. So you have to be responsible to the board. As a employee of a nonprofit, I'm responsible to my CEO and to the board of directors around the financial well-being of the organization. So when you look at internal controls, are basically processes and systems that you put in place to, frankly, try and prevent fraud or theft from the organization of its assets. I'm sure you've all heard of circumstances where, the bookkeeper ended up with $1 million in her bank account. And the idea behind internal controls is to have enough checks and balances in place to where no one individual has enough power and individual authority to actually be able to do that. Now, when you have an audit, audits do not look for fraud. That's not their job. I mean, you can hire an accounting firm to do a specific fraud audit if you have concerns or you're worried about it. But basically, their job is to look at the internal controls, say, are these controls sufficient? And to do some testing of your internal controls and say, are they following the internal controls that they put in place? But they're not going to dig in and look at canceled checks and stuff like that for signatures and all that others. That's a separate kind of engagement that you have to ask for. They do look at the particularly internal control. Probably the biggest or the most well-known internal control is what they call segregation of duties. So that means that you have the person that's actually putting the invoices in, cutting checks, and issuing checks is not the same person that's signing the checks and the same person that's actually, when the checks come back, not doing the bank reconciliation. So that's segregation of duties, particularly in the accounts payable. Yes?
Just say that last sentence again. The person who cuts the check is not the
person that signs the check, and not the person that looks at the bank statement and does the reconciliation to see what checks have cleared the bank. Now, in a large organization, like in my organization, we have 3 people in our finance team, and so we can manage that very easily. And in fact, as CFO, I don't have the authority to sign a check. That is we have a COO, we have the CEO, we have other people on staff that are given that responsibility. The same thing, I can't wire money, I can't do ACHs, that kind of stuff. So because I supervise the people that do the bookkeeping and that do the accounts payable. So the tightest to control is if you don't have anybody that ends up with the ultimate. Yes, ma'am.
So I didn't want to interrupt your thought there. So I have a question about that too, because I've been with very small organizations, and in some cases, sort of those, especially if we needed a double signature or if we needed an approval of reimbursement to the executive director, it was to be a board member, which no longer is very practical to run around and try to get signatures on paper checks. It was logistically nearly impossible for us. And I didn't know if you had, like for the really small organizations, an alternate way. I mean, I can tell you what the last organization, and I don't know that this is sufficient, but we did do a process of emailing emailing the information, and then the person responded with their email saying I approve or what have you. But I was kind of curious.
Well, absolutely. That if you have a smaller organization, then you have to be a little more creative. The other thing is that the concept of two check signers and that sort of thing, a lot of things have changed with the digitizing of our accounting processes. So, yes, ma'am.
I was going to say that we've just taken things electronic and sort of eliminated the actual physicalness of somebody needing to actually sign a check. So it doesn't help in the instance where necessarily the executive director or the CEO needs to get reimbursed, but we run everything through bill.com and have a signature process where I'm approving it for a coding perspective, and then it goes to the COO, and then it goes to our CEO, and eliminated sort of chasing people around that are working from home or
right.
working remote.
Are they in essence just click to sign type of thing then?
Yes.
Okay.
Mm-hmm.
Yeah, and I think that's another way to handle it is to do it through the approval process rather than physically having to sign something or handing it off. Because I know trying to get a board member to be available to sign a check is not easy. They're not around all the time. So yeah, if you can automate it, if you can use a product like Bill.com, or there's lots of different products.
You do it through your bank too. Banks don't necessarily let you route it though to different people for signature process. So
Yeah,
outsource
yeah.
them.
But you can, and I know some smaller organizations where the first person to open the bank statement should be like the executive director or someone that's not in the finance chain, or a board member or whatever. Just that's just good practice, because otherwise it could be manipulated. And I mean, you want to trust your staff, but you have to put stuff in place that helps with that. So, and there's a whole list in your handout. There's a whole list of specific controls that you can put in place. Things like storing checks. I mean, not even everybody has check copy anymore, so that's not necessarily as important. I know our check stock is blank, so it's just a piece of paper. And the way our check printing works is that everything, including your account number and all that other stuff, goes onto the check when it's printed. So the checks, it's not that critical. I mean, we do keep our check stock locked up, but it's not that critical because there's really nothing anybody can do with it to put an official check onto that stock paper. So limiting the people that have access to that kind of authority and that kind of work. So. guess I'll go. I mean, do you have any other questions about internal controls or understand the need for that and how that works?
I have
Yes.
a question, but I'll wait till the end. Probably, it's not completely relevant, but it is about internal control. I'll just wait to make sure you have time at the end.
Okay. I'm sure we'll have time.
Okay.
Okay, so the next thing that I've been asked to talk about is nonprofit financial reports and what board members need to look for when they're looking at the financials. And I know a lot of times board members are not necessarily business people or finance people that spend a lot of time looking at financial statements in the rest of their work. But there's a couple things to note. One thing is that nonprofit financial statements are not exactly like for-profit financial statements. They've been, because the drivers behind nonprofits are different, they're rarely like earned income. I mean, nonprofits can have earned income, but that's rarely what your main financial driver is. So there's no profit necessarily associated with it. And so there are the things, but many of the things on the financial report look just like a regular financial report. So I'm sure everybody's heard of a balance sheet. In the nonprofit world, that same exact document is called a statement of financial position. And all this stuff comes from a place called FASB, which is the Financial Accounting Standards Board. And they are a regulating organization in the United States that says this is what has to be included in your financial statements. And so a lot of this stuff that comes out of there will never relate to your small nonprofit in a million years, but know that your auditors have to keep track of that because it has to be, your financials have to be presented in accordance with that, and GAAP, which is General Accepted Accounting Principles. So when you look at the balance sheet, I will say the first thing I look at when I look at the statement of financial position is the thing at the bottom that's called net assets. So, which is in a for-profit financial statement might be your equity section, but because nobody owns any of the assets, it's called net assets. Usually, there may be different categories of net assets. There could be net assets with donor restrictions. That's what happens when a donor gives you money for a specific purpose. Let's say you're doing a program and it lasts for 2 years, and they've given you $100,000 to run a particular program. In the first year, you only spend $50,000. That other $50,000 goes down to your net assets and sits there waiting for you to spend it. So it's as a nonprofit leader, as a part of the board, it's important that that number be a positive number. Now, it doesn't have to be enormous, but if it's a negative number, that's a red flag, and you need to look into that. You need to talk to your finance people and have a conversation. That's really about the whole, like, where the organization is going, whether or not the organization is viable, whether or not the organization can continue functioning. So they could have cash, and they could have accounts receivable, and they can have other things that look good. But if their net assets are negative, it's just something you need to look into. Now, sometimes net assets go negative as a part of just a timing thing. You know, you're waiting for a contribution to come in or a contract or whatever. But if it's consistent and it goes on for a long time, then you know you have a problem and you need to look into that. You also want to look at the liabilities that the organization has. Do they have an unequal amount? I'll put it that way. When you look at your assets and your liabilities, are the liabilities far greater than the assets? So are they not paying their bills on time? Are they not submitting their payroll taxes? Are they not? That's where that gives you a hint. Have they borrowed money without getting board approval? All those things pop up in the statement of financial position, and those are the things you want to look at. Also, they may have accounts receivable. Are those accounts receivable really viable? Are they really going to get that money? Or someone said, well, we asked for a grant and we think we're going to get it, and whatever. That you can't count that. So you just want to make sure that you understand what's sitting in accounts receivable or grants receivable, so that you're sure that the organization is going to have enough money to go on through the next year. That's pretty much the balance sheet or the statement of financial position. Then the ins and outs of the organization, the revenue and expenses of the organization. In a regular financial statement, that's called the income statement. In nonprofit accounting, that's called the statement of activities. So, and one of the reasons that they gave them these different names is because technically there's no concept of like profit and net income in nonprofits. So, they say this is your statement of activities. It's not your statement of income, and it's your statement of what's happened in your organization. Also, because of the way nonprofits have to record restricted revenue, it also changes what that financial statement looks like. Because when you get a grant or something that just is a contribution, somebody says, William Penn Foundation gives you a grant and says you can work on this program for the next 2 years, you have to record the entire grant as revenue, so to speak, as income in the first year you are awarded the grant. Whether you get the money or not, that's not the point. You have to record it as revenue. And then the next year, when you're spending that money, it sort of looks like a loss, because now you're spending money that you recognized the prior year, and then so it comes out as more expenses than revenue. In nonprofit accounting, the matching principle does not always work. In other words, normally, when you spend money, the revenue matches that and you end up with net income. Because you have to record contributions when they're awarded, not when they're received and not when they're spent, you sometimes end up with a year that looks like you have a loss. But that loss is using restricted net assets, which, as we talked about on the balance sheet, are sitting there waiting to be used. So it's appropriate. So don't necessarily be alarmed if you see in a given year that an organization has a loss. That's not necessarily a bad thing. Now, if it's a huge loss and it takes you into negative net assets, then you should be concerned. But otherwise, that's the normal ebb and flow of income and expenses in a nonprofit organization that receives restricted contributions. And it's noted specifically as, on the financial statement, as use of restricted assets. So you'll see that, so you'll know how much of that is associated with whatever negative that you're looking at in the end. The other thing that's important to look at is cash flow. So income and expenses, nonprofits, for the most part, unless they get an exception, are required to report their income and expenses on the accrual basis. What that means is you have to recognize an expense at the time it's incurred. So, and then revenue, as I said before, you recognize the revenue at the time that it's awarded. That doesn't necessarily relate to, like in your own personal life, you get cash in, you spend your cash, and that's your bottom line. It doesn't work that way in accrual accounting. Accrual accounting says, sometimes I have a liability. I have something else that I'm going to need to spend. I haven't paid it yet. So you might have a lot of cash sitting in the bank, but if you also have a huge liability sitting on your balance sheet or on your statement of financial position, then you need to be concerned about that. These are the things you need to look at when you're looking at a financial statement. So generally speaking, you should ask your organization to prepare a statement of cash flows. It does not have to be like super detailed and list every single thing, but just the idea of here's how much cash we started the year with, here's what we've actually spent so far, here is the revenue that's come in the door. So it doesn't take into account accounts receivable or any of that stuff. It's just cash in and out. But that's also something that you want to know. You want to make sure that there is enough cash to pay your bills and that and to keep the organization viable. And the other thing is, which is a delightful position to be in, you might have too much cash. You might say, you know what, maybe we should be investing this. Maybe we should be putting this at least into a money market that will, earn us some interest or something like that. Some of the banks have very good sweep products that you can say, I only want to leave $50,000 in the bank, and then every night, anything over that, sweep it out of my account and overnight invest it. I mean, you have fiduciary responsibility. It has to be solid product and all that other stuff, but that's a way to earn some extra interest income. Yes, ma'am.
You use the expression accrual accounting, and I see here our budgets and forecasts done on both a cash and accrual basis. Could you define what you mean by accrual?
I'm sorry. Can you speak up a little louder?
You mentioned accrual accounting, and in the slide it says budgeting and forecasts, are they done on both a cash and accrual basis? Can you explain what you mean by accrual?
Yeah, just what I'm saying, just what I was talking about before. Cash basis is just what it sounds like. Cash in the door, expense payments out the door. Accrual basis takes into account things like you get an award and it's for $100,000, but they only give you $50,000 the first year. You have to you have that $50,000 sitting as a receivable on your balance sheet. Okay. And the same thing is with expenses. Let's say you get to the end of your year and you've engaged a consultant. They've done the work, but they haven't billed you yet, so you haven't paid them. But you have to record that expense because you owe them the money, even though you haven't actually been billed or paid them yet. That's kind of what I'm talking about.
Okay.
Does that make sense?
Yep. Thank you.
Okay. So, and I will tell you that I don't do a cash basis. I don't do a cash basis budget. I just do, because I find that confuses people. I do a accrual basis budget, and then I do a statement of cash flows for the board to see, so that they can see what the cash stuff is, but I don't try and base a budget on that. So many times it's timing when your money comes in and when your money goes out, and it's also you can somewhat manipulate that, because you can say, you know what, like we have a policy that bills get paid in 30 days, not the day we get them. We don't turn around and cut a check the next day. We say we pay our bills in 30 days. We tell all of our vendors that's an appropriate expectation. But so in the meantime, I might get an invoice, but it's not going to get paid for 30 days. So if I get an invoice on September 20th, it's not going to get paid till October 20th. So the expense is there, but you haven't lost the cash yet. So I just prefer, this is for me. For a smaller organization, it might make a lot more sense to do both types of budgets. But, we have about $20 million to account for, and to do two different budgets on two different bases, and it doesn't really have any value for the board. So as long as I give them a cash flow, because cash flow, the other thing cash flow will tell you is, let's say you have a capital project coming up. You need to put a new roof on your building. Well, that doesn't show up as an expense because you have to capitalize it and depreciate it over time. Mm-hmm. So that's accrual basis accounting. So I also do a capital expenditure budget so that I can say, but here's the expenses that are going to hit the bottom line. But then here's some of the cash that we're going to have to outlay in addition to that. Yes, ma'am.
Much of our budget is reimbursable. So for the cash flow statement, you would include what what you've invoiced essentially for that quarter. You would include that as in your cash flow statement.
No,
Okay.
that is cash flow is strictly cash in the
Cash flow is
door,
cash,
cash out the
okay.
door on a particular date. That would be in your accrual basis accounting, and that would be a receivable, and you'd be saying, we spent this money and the grant owes it back to us.
Okay.
So that would be on your statement of financial position.
Okay.
Okay, let's see, what else? Well, there's questions in here about like who should be doing all this stuff, the analysis and that sort of thing. I would say, if you have a large enough organization that you actually have a controller or even a bookkeeper or a CFO or whatever, then certainly they should be doing analysis, budget versus actual. The board should see that at least once a quarter to see how they're tracking along with their budget and that sort of thing. If you don't have the staff that can do that, some people may have their accounting outsourced, and so you're outsourced. If you were in the last session, Louise Smith has Countryside Accounting. They do that sort of thing. Or you can talk to your auditor about it and ask them for some help in doing that analysis if you don't have anybody on your board or a staff person that can do that for you. It is important to look at your budget versus actual throughout the year. And frankly, your staff should be following that, and they should be right on top of it and know how much they've spent and how much they have left to use in order to accomplish your mission, because that's what it's all about. There's questions in here. Members should ask about a nonprofit auditor.
Just a quick question Mary has about the engagement letter.
Yeah.
Can you just talk about that as far as it not being the executive director?
In theory, an audit engagement is engaged in by the board. The board engages the auditors, not the people. So, there's no law about that. It's just kind of considered a best practice. I'll tell you honestly, at my organization, I sign the engagement letter, but only after the chair of my audit committee has reviewed it. And that's a matter of, as we were talking about earlier, just, the chair of my audit committee lives overseas right now. So, what am I going to do? So I send it to her electronically, and now that we use DocuSign, she could probably sign it electronically too. But that's just a best practice, because as I said, it's actually the board that engages the auditors, not because it's supposed to be independent of management. Okay. And engaging auditors, I don't know, do you all get audits of your nonprofits? Mm-hmm. Does everybody do that? Okay, because, if it's a really small nonprofit, you don't have to have an audit, but pretty much the state of Pennsylvania requires an audit if you have more than $100,000. So, and the federal government is a little higher, but in Pennsylvania, it's $100,000. So that is usually a process. I'll tell you a couple of my own things. Years ago, when we had Sarbanes-Oxley come out, that was back around WorldCom and all that mess. They came out with saying you need to change audit firms every 3 to 5 years or whatever. For nonprofits, that's not really the case. First of all, we're not subject to Sarbanes-Oxley. That's all about public, stocks and bonds and all that other stuff. But it isn't. I personally don't think that that's necessary. Should you review, talk to the auditors, and you may want to change partners. You may want to change the people on your team. But it's not really necessary to change firms unless you have a reason to, unless you feel like they're not giving you, they do the audit and they don't come up with any suggestions for improvement. You might say, wonder why that is, and it might be a perfectly legitimate reason, but after 4 or 5 years, you may wonder, are they really like as dedicated as they were? Are they phoning it in, whatever? But if you don't feel that way, if you feel that they're doing a good job and they're giving you the product that you want, it isn't really necessary to change all the time. Because from my perspective, I like the consistency of an audit firm that understands the business. The organization I first is pretty complex, and to bring in a new auditor that doesn't know the business, that doesn't understand how things are supposed to work in a destination marketing organization, creates a whole new challenge for the organization. So, but if you guys feel that if your board feels that you want to have new auditors on a more regular basis, that's okay too. But you really should go through an RFP process. You need to find out what their fees are. You need to find out how they explain their audit objectives, how they go through determining what they consider to be material. We have our audit committee. We have a separate audit committee, which is also not required, but we just happen to have that. And we meet with them twice a year. One time they meet with the auditors before the audit starts to talk about the whole process, what they're looking for, what their planning process is, and so forth. And then we meet with them again when they're presenting the completed audited financial statements, and which, the board audit committee needs to approve. So I don't know, unless you have other questions about your auditors, I think it's there's a whole bunch of stuff in here with these audit checklists and stuff. Please look through those if you have any questions or whatever. Again, some of these may have been affected by the change in how much we rely on digital information at this point. And I will say, I have not had an in-person audit since 2020. So the auditors have learned to do everything. I give them access to my accounting system, and we provide them with a lot of information, but it isn't really necessary. They don't anymore come in and tick and tie. They don't need to see canceled checks. They don't need, because all of it's automated, all of it's digitized. So, but I do go ahead and look through that, see what there is. That if you have any questions, happy to answer. And now I'm going to turn it over to Nick because I'm exhausted.
I'm just curious, Cindy, how long has your organization been with the same auditor?
We have been with the same audit firm for 10 years.
Wow.
And we do have a different partner within that same firm now. We just switched 3 years ago. That was really because the partner retired, not because we necessarily were unhappy with the work. We're not unhappy. I love my auditors. They are available to me throughout the year. If something weird comes up, we got a new lease. There's a whole world of accounting stuff around leasing office space. And I needed some help with how I was supposed to keep track of that and how I was supposed to report that. They were available to me that. They give me lots of information when things are changing and so forth. So I'm very happy with the auditors that we have. So
Consistency and reliability, all those things play a big factor. And if your board hasn't decided, hey, every X amount of years we're going to switch, then as long as they're doing their job, then I guess you stay with them.
Right.
Awesome.
Yes, sir.
Is there a strong argument for separating audit and finance?
I'm sorry,
Should there be an audit committee?
There really does not have to be an audit committee. I mean, I've been on boards where the finance committee was the audit and finance committee. Again, that separation of finance committee and audit committee came out of Sarbanes-Oxley back around, the turn of the century. And so, it is not a requirement. And I think it probably also, it's a decision that the board needs to make. How big is your board? How many people? Do you want a separate committee? Do you have some people that maybe have an expertise in that area, and that's where you want to put them? But it's not a requirement.
Is it have any impact with the larger budget? Like you said, you're 20 million, so that's, pretty significant for a nonprofit. So did it come out of that, or not necessarily?
No, this is in the bylaws from when we were founded in 1996. And the budget that year was like $800,000. So it's not about the size of the organization. It's just how our board decided they wanted to manage it. And they like to be able to put that responsibility for approving. Also because we don't have the board approve. They delegate that responsibility to the audit committee. So the audited financial statements are reviewed and approved by the audit committee, which is about 5 people that have more of a background in that.
Awesome. Any other questions on the audit side, financials? Awesome. All right, we'll move on. I'm going to discuss 2 topics. The IRS Form 990. Just give a little background what that form is, why it's important to you all as board members, and then the importance of GuideStar, which is a software organization, and we'll kind of tie in the 990 and financials into GuideStar. We'll have a brief discussion about that and then hopefully open up to some questions. So IRS Form 990, I'm sure everyone's pretty familiar. That is the nonprofit tax return. The 990 is really a informational resource. I like to look at it as a resource for the organization to really do 3 things. I think number 1, it's compliance. So yeah, there's a requirement by the IRS to file this tax return and file it timely. So there's a compliance piece, and it may also, you may have to submit the 990 to different grantors or organizations that need to see it at a certain time. So compliance, transparency. I think the 990, number 1, the 990 is a public document. So the 990 goes on the IRS website for public distribution. Anybody can go on and find a nonprofit's 990. The 990 then also gets sent to GuideStar. So it's out there, and if you're a nonprofit organization and if you're on the board of that organization, that's your opportunity to do a lot of things. State your mission, make sure that you're representing the organization in the best way possible, that you're delivering the message of what your organization does and hopes to do through its programs, through its fundraising efforts. And then all the financial data is also listed on the 990 that, obviously you want to try to show your organization in the best light possible, because being a public document, you never know whose eyes are going to be on that document, whether it's potential donors, potential staff, just your community at large. And I think if there's a chance that any eyes are going on that document to make a decision, whether to make a donation or somebody wants to work for your organization, I think it's a pretty important document. So, and then the last thing I always think is important is analytics. The 990 gives you a chance to look historically, as do audited financial statements, but you can start to look at prior year's performance, prior year data analytics, And this is where GuideStar comes in, and I'll get into GuideStar a little bit later, but that's a way to look at, year to year revenue growth, where your expenses are, where the money's being spent, compensation of officers, directors. Are you in line with other organizations in your sector? So there's a lot of good things that can come out of that. Again, compliance, it's required, and it's an opportunity. I always say it's a resource. It's just a way for you to show off your organization. Page 1 of the 990, one of the first sections is state the organization's mission statement. And I think, bam, that's anybody's eyes, that's kind of one of the first things they see. So that's where they start, and then they say, okay, I understand what this organization does. Now let's see how they perform and what programs they get into. I'll run through some of these bullet points, and I sort of touched, the 990 is going to be made up of a lot of the areas that Cindy had touched on that are included in the financial statements. So within the 990, there is a balance sheet that, again, you can analyze the cash balance, the net assets of an organization. There is the income statement that will show you where the organization's making money, where they're spending money. Programs will be broken down, and there will be descriptions of the different programs that your organization performs. Again, all an opportunity to disclose what the organization's doing, how they're servicing the community, how they're relating what the organization does back to the mission statement, and ultimately, where the funds are going, which, these are all major donors are going to be looking at these different areas. There's various levels of governance reporting. There's a bunch of yes/no questions about, does your internal controls are covered to an extent, is your organization issuing 1099 forms, which are more tax-related items? But there's yes/no checkboxes that you want to make sure you're answering yes to all the boxes you want to answer yes to. Your officers and directors are listed, along with the names will be publicly. I guess the names are listed for officers and directors, right? I'm thinking for contributors. I'm sorry, I'm thinking about money coming in. So names listed, their duties, and their compensation. So, eyes will be on that from a analytic standpoint, and also organizations within the sector to kind of compare and see how they rank and make decisions. Let's see here. Public support. So there's Schedule A of the 990. Public support for a nonprofit is important. You need a certain percentage if you're a 501c3 to maintain your 501c3 status. You need over 33% of your support to come from public support. And there's deeper, more complex calculations to make sure that you maintain that public support percentage, but that schedule is laid out. There's a history of years that show your public support, and that's something as a board you want to make sure, whether it's your finance committee, whoever is in charge of sort of analyzing your finances, and also the 990, that they have an idea of what that schedule means, and that they're ensuring that, hey, this is not an issue that we need to worry about. Schedule B, list of contributors. So there's where our names are blacked out, but it gives an opportunity to show where your money's coming in, major gifts, and it shows a diverse community support. And I'm just looking at other schedules we want to talk about.
Yeah, on that one, on Schedule B, that is, you have to complete that for your submission to the IRS, and you have to put people's names on there. So you can't put anonymous or you can't leave it blank. However, that Schedule B is not part of your public disclosure document. So that's extracted, as Nick said, or the names are blacked out or whatever it is. So you don't have to disclose who your donors are publicly. But you do have to tell the IRS who they are.
Awesome. Again, in your handout, there's a really great slide here that goes through all the different parts of the 990. I don't think we want to spend the time to go through each one. Many of them I've already touched on. Statement of program service accomplishments. That's a really great one to, again, highlight your programs. Statement of revenue showing the different sources of revenue. You know, you've got revenue coming from your programs, from fundraising efforts. Statement of functional expenses. Here's where you can break down how much of your money is being spent on programs, how much general administration, how much fundraising. Again, I like all this because it helps me generate analytics. Even just, I'm a numbers guy, so when I can look at a form and kind of see numbers, they'll pop off a page for me. So if I see a large amount of money going to general administrative, at least it starts you to ask questions and say, where, you know, why do we have a high number there? Where does that come from? Compensation of officers, directors, we touched on that, and a bunch of government and management disclosures. So again, just a great thing, I think, as board members to understand that there's a lot of information there. When your 990 is developed and presented, I think everybody's got a responsibility as a board member to at least read it and to try to understand it to your best ability. And you know, as a board, you're approving the 990 before it's filed, so ask questions, do your best to understand, and get engagement throughout the board so that before it's filed, everyone's confident with all the numbers, the figures, and the information that's being delivered. A few more schedules. Again, there's related party transactions that can get disclosed and listed on the schedules. You know, I'm not going to spend a lot of time going through each schedule and section. I had mentioned that the 990 gets publicly displayed on the IRS website. The IRS also sends the 990 to GuideStar. And GuideStar is a website that is another great resource for board members, potential donors, really anybody in the nonprofit world that just wants to learn about an organization. GuideStar does a pretty cool thing. They have a seal of transparency, so I mentioned that's pretty important, I think, to add legitimacy to your organization, again, to attract donors. The more transparent you are, the more information you give, I think the better chance that a donor feels comfortable about what you do and wants to support you. The more information you give GuideStar, meaning more historical data, the more background about your financial statements that can get uploaded. The more you put up there, the better chance you have of moving from the bronze seal up to the platinum seal. And I think, again, people that are going to look there, if they see platinum, they're like, oh, okay, this is a legit organization. I really trust what I'm seeing here, and I can get a great deal of information. And these are all just different organizations that you know, people give through a lot of different ways. They make their way back to GuideStar. So I do feel like somebody on your board should be aware that GuideStar exists. Check out your profile, see what it looks like, and do the best job you can to make it look as good as you want it to look. Question?
You're talking about a lot of positives of what the 990 can bring to the organization and what GuideStar's visibility on 990 can do. But I know several 501c6s in particular, membership organizations that are not for profit, that haven't filed a 990 in years. And I think the one that actually asked me to serve on their board, and I went to GuideStar and I saw that they hadn't filed in years, and that made me not want to serve on their board. So if an organization is doing just fine kind of on its own under the radar, not filing a 990 yet, it's still pretty active What are the negative consequences that the organization could face, and what are the negative consequences that board members or officers could face?
Yeah, great question. I think for me, I'd sort of be hesitant as you were to say, hey, these are things that most organizations are doing, and I'm seeing that you're not doing it. So it makes me ask a question first. I'd be concerned from a compliance perspective, and maybe before I choose to serve on that board, I ask, I've noticed you haven't filed 990s in a few years. And I don't know the 501c6 requirements, but I'd ask the question, what are your filing requirements? And if you're behind, or if why are you not compliant currently? What's your plan to become compliant? I just think it makes you stop and ask questions before you jump into a board if that's the situation.
There is also a financial, cap. So in other words, if your nonprofit makes under $100,000, I don't think they have to file a 990. They can file a postcard to keep their 501c. Well, I know for C3s, you can keep yourself active, but if you don't have that much revenue, then you don't have to do a full 990. Some people choose to do one anyway, because as Nick pointed out, it's a marketing tool for you if you put the right information in there and really sell your you can really sell your organization that way. But if you're required to file a 990 and you don't, there are financial penalties. They will come after you. Not you. They'll come after your organization. So.
Thanks, Cindy. So,
Question.
yes, sir.
Follow up on what are there ramifications to the board members then so you're over $100,000, right? And you walk into a situation where they're not doing they're not doing what they're supposed to in filing the returns and so on. What exposure is there to the members?
Great question. I know organizations can have directors and officers insurance that may cover some of those ramifications. Cindy, have you ever encountered that in your tenure?
I've never encountered anybody that if they did get a penalty, their organization couldn't cover it. But theoretically, just like anything else, when you're a board member, first and foremost, make sure they have D&O insurance, but you are responsible. When you're a board member of a nonprofit, you accept a certain level of fiduciary responsibility. Now, that doesn't mean they're gonna take the money out of your bank account, but it means you have a responsibility to get things right, to make sure that they fundraise or they do whatever they need to do to get the money to pay their bills, especially to the government.
Yeah, I know when I first joined my first board, that was somebody had told me, because I had all these questions. Well, first question you should ask is before you join, make sure they have D&O insurance.
Yeah.
Bam. Step one, then find more out and decide if you want to join. So.
I'll be surprised when I meet with new board members or potential how many don't ask me that.
Yeah.
And I tell them, I'm the one that's telling them that. I'm just so surprised sometimes how many people don't ask me that.
Yeah. Interesting. I just want to point out, we'll kind of quickly get through the last few slides. The Chester County Community Foundation was kind enough to share their login information about GuideStar. So I know it's in the handouts. I just want to point out that password has been recently updated. So as most people, you probably have to reset your passwords all the time. I do have the updated password. It is 23 Matilda, that's MATHILDA, exclamation point.
Capital M and lowercase m.
Capital M.
Can you spell Matilda again?
Yep. So it's 23 MATHILDA, exclamation point. I just found it out this morning as I went to log in, and it worked a few days ago. Doesn't work this morning. So I'm like, let me get the right password for everybody. So, and the email address, when you go to GuideStar, email address, that's all you have to do. Email, password. So you can get in and browse around if you don't already have a login for your organization. The Community Foundation was kind enough to offer their login. I'll flip through these slides, but just so we can keep the discussion going. GuideStar is a really cool tool that you can use to look at your own organization if you've got years of information in there. Really cool line graphs. I mean, depending all the stuff, however detailed you want to get, there's a lot of information you can pull out of this. You can also compare to, as I said, this is interesting to me, other organizations within your whatever industry, sector, or region. So this is just an example of senior centers in Chester County. There's 5 different senior centers with a lot of great financial information that if you're a donor and you're like, hey, I want to give some money to a senior center, and you're not sure which one, they may be looking at something like this to make that determination. So I know we're close to end of time for this session, so I'll just wrap it up with that. Thank you all for your attention. Any questions on the 990 GuideStar financial statements, anything we covered today?
I was going to comment. I used to serve as the chair of the Grants and Scholarship Committee, Grants and Scholarship Policy Committee here at the Foundation. And we absolutely use this information as we receive grant applications to determine what nonprofit would be awarded that grant money, because there's so many wonderful causes and wonderful organizations, but there's a limited amount of grant funding available. And so this is one of the factors that we use to determine who would be awarded the money.
Awesome. Thanks, Eric. Yeah, it's a great tool. And just from hey, what are they about? What are they doing? And then how are they performing? It's kind of easy to get that information really quickly, too.
I'm just going to circle back on the internal controls real quick, and this isn't relevant for everyone, but with things being electronic now and being online and requiring multi-factor authentication things, it's kind of been a bottleneck for me. I'm actually in a nonprofit, and I was just wondering, since you're in a nonprofit, if you've had any experience with that and sort of any workarounds. Our CEO is listed on everything, so when it's a multi-factor and it has to go to a cell phone and it has to go to her, I'm looking at a holding pattern quite a bit, and lately it feels like it's often, and I just was wondering if there's any best practice or tools, or if that's just sort of it.
I work in IT services and cybersecurity, so I'm going to hijack the answer to this question. They can answer it or add or correct me if they wish, but every individual that needs access to that resource should have their own username and password. And every organization that you're working with should have some capacity for granting an individual username and password, but that way you shouldn't be logging into somebody else's account. Next, my brain a little bit when they share the Community Foundation's password, but I understand that's what they do, and there's nothing you can really.
It's not necessarily related to e-grant or just grants or anything like that, but actually it's more towards banking and financial activities that.
That's all the more reason everyone should have their individual credentials.
I'm not finding that that's availability. This is really, I'm drilling down, and I apologize, but just even setting up Venmo so we can get donations, it all goes back to the one user, and you're not allowed to have multiple. They don't permit multiple.
Because we just had a PayPal.
PayPal is Venmo's owned by PayPal.
Right, and so PayPal, we have one contact, and it's our CFO, and when we were taking online payments at a golf tournament, we had to use his logins. We could do it on our phones.
Yeah, it is.
That's your using individual account?
No, this is, I've gotten a certified through PayPal as a nonprofit organization, and it has become a huge circular motion between PayPal and Venmo. Lots of people want to give donations via Venmo or PayPal, and I just was wondering if you were having any. So I'm not alone, and I'm not isolated.
And that's probably where the technology is lagging behind the user interface. So.
And there are some ways to do it. So keep after Venmo and PayPal, because they do have venues for you to create multiple users.
I've been online with them multiple times, either chatting or talking, and I need to go back to the primary, and that's the only way to get
chat to our banks about that, and finally they can see we got the chair of the finance committee and the financial director both full access. It's a little high, I agree.
But it's not easy.
Thank you.
Yeah, I have some of the same issues. I mean, where I can, I do set up 2 administrators. But even that, I mean, I'm not the person, I'm not the person that goes out in the field and goes to events and, you know, does all
Right,
that.
right.
So I understand what you're saying. We don't take Venmo. And frankly, Visit Philly doesn't get donations. People don't want to give us money.
We just had, you know, we have all kinds of small types of things at restaurants and 20% bids. And,
Right.
events that, yeah, absolutely, and we're a smaller budget, so, anyway, it is what it is. I'll keep fighting for it.
Yeah, awesome.
Gotta go.
Very good. Go eat lunch. Thank you.
Thank you.